or resume.
There we go.
You got it.
Recording in
You got it.
progress.
Yep. Good.
All right. So, good evening, everyone. I'm Rob.
Hey,
So,
Rob.
in Charlottesville, Virginia. And tonight it's going to be a little different. I'm going to be presenting. I'm not actually going to be presenting. We're going to have a guest presenter. It's called a video. 1031 exchanges. It's like a guest speaker, only he's not here, which is kind of cool. I am familiar with 1031s. We did one ourselves. When I say we did one, my wife and her sister in southeast Wisconsin, when their father passed away, they inherited a 400-acre farm. So they're not farmers. My wife's a nurse, and her sister is now an official with the local county up there. But regardless, they didn't know anything about running a farm or anything, and so they put it on the market, and after several years, it finally sold. So rather than pay, capital gains taxes on 8 figures, we decided to roll that over into a 1031 exchange. So we did some research beforehand. I have always studied multifamily stuff, and I've been in real estate long enough to know and been studying various methods of investing in real estate that this was the way to go. So we found an intermediary, and because that's one of the things that you have to have for 1031 is an intermediary. They kind of control everything and make sure that you meet your deadlines, and make sure that the money comes in where it's when it's supposed to and goes out when it's supposed to, because even 1 second in your own hands can really hamper that 1031 exchange, and then you end up paying capital gains taxes on it whether you wanted to or not. And right now, capital gains taxes are running 15 to 20% depending on your income, so depending on what you're rolling over. So you need to have, you need to be cognizant of what you're looking at there as far as what your proceeds will be. And you have to consider your mortgage, what any mortgages on it, depreciation, a lot of other things that you have to consider. We were fortunate enough, we had a good intermediary, and we had really good commercial brokers to help us through it. So we identified properties, we identified some student housing, a regular apartment, another Class A apartment building in Madison, Wisconsin, and we looked at some retail space, commercial retail, as in Walgreens, CVS pharmacies, things of this nature. And we quickly ruled those out because just the nature, who wants a 20,000 square foot building when CVS decides to close its doors and move across the street with a new building. So we just stuck with multifamily. We ended up getting 4 student housing buildings, a parking lot in Milwaukee near Marquette University, and a regular, just a normal apartment building on the west side of Milwaukee. And then they became senior equity partners in a Class A large apartment complex in Madison. It's not student housing there. It's just a couple blocks off of Interstate 94 south of the I. But everything's been working really, really well for the past. I think we've held them now for everything for 5 years, going on 6. But my wife and I are aging. My sister-in-law, she's getting ready to retire because her boss is retiring, so she's going to retire. So we put the student housing on the market and the parking garage that's in that same neighborhood on the market, and we are under contract for that. So, and that should be closing in October. And because it was in a corporation, you can't just like my sister-in-law, if she wanted to invest her portion, she could not take her proceeds and roll it into a 1031 exchange because the corporation owns the properties, not her herself and not my wife herself. So as a result, everything has to be done via corporation. So they would have had to agreed to to actually take the proceeds from that and roll it into another situation, another 1031. So, and they've elected uh, not to do that. So we're actually going to pay those capital gains taxes this year, and we decided to do that because, as you know, our current administration, they're looking at, increasing capital gains from 20% to, I've heard as high as 39%, which is almost double. So if you're rolling over, I mean, if you end up selling your property and you get $10 million, do you want to pay $2 million in taxes, or do you want to pay $4 million in taxes? I don't want to pay any of it, but we got to pay Caesar what's due Caesar, right? So it's just the laws in our nation that these are things that we have to do. So they've elected to go ahead and just, take the proceeds, and then individually we'll be doing our own investing or drinking margaritas on the beach. I don't know yet, but I'm all for margaritas on the beach, but we'll see. So does anybody have any questions at this point, or comments, any past experiences with 1031s, if any?
Oh, I was going to ask if those are blended or on the rocks.
Mine are going to be on the rocks because I don't like slushies because they hurt. So so I don't know about anybody else. All right. So what we're going to do is, as I did a lot of research on this, I was going to try to do a slideshow presentation and cram and learn, but the sensitivity of a 1031 exchange is so great, and I found a national company that does 1031 exchange as an intermediary. I don't know what their charges are. I don't know what the cost is. I don't even recall the cost when we did ours. I tried to go back and find it, and I couldn't find it. So it's wrapped up in the closing costs somewhere, I'm sure. But I did find a company, and they have offices in virtually every state, with the exception of our Oconus, our Alaska and Hawaii. I don't think they're in either one of those two. So, and I'm not for sure. And this is a U.S. law, so it does not apply to Canada. So keep that in mind as well. So the company's name is IPX, and I was researching their site, and they've done a great job. They have a lot of different videos, and I'll share in the chat box. I'll go ahead and put that now while I'm talking. The website of the company itself. I believe it's 1031. It's IPX1031.com. I believe it is. If it's not that, it's just IPX.com, but I think it's what it is. And they've got a webinar now. This webinar of theirs is right at an hour, so I thought it was a good fit for our group because we tend to go a little over an hour anyway. And they do a good job of explaining it. They do it day in and day out. That's all they do. So they can definitely pay homage to the IRS law, Chapter 1031. So if everybody's ready, I'll go ahead and start that, and then I'll share the link, and you can get from that link I shared, that IPX1031.com, you can access this webinar, a bunch of different shorter videos which talk about the minutia of it. There's like 6 or 8 of those. So I encourage you to, if you have someone who's looking at do a 1031, or if you have your own properties and you want to do a 1031, I highly suggest that you, and if you've never done it, I highly suggest that you start here, and look and see what they have. Educate yourself, and that's what I'm trying to do. I'm just trying to educate us so that we have not an in-depth knowledge of how to do a 1031, but enough to keep our licenses active, and enough to keep us out of jail, and try to keep our clients from paying more money than what they should. So at some point, I think it's incumbent upon us as agents to not assume the duties of an intermediary or anything like that, to leave that up to those who know what they're doing. Susan, you've done a lot of investing and have a lot of clients. Have you ever done a 1031? You're muted.
Sorry about that. I did back in January. I did 4 properties on a 1031 for one client. Personally, I have not done any of them, and I think it was the same company you're talking about. I think it was IPX that they went through. So It was not difficult. It's just like you were saying that we have to identify within a certain amount of time and then close with 180 days. And
Right.
we actually just finished one too, the last month. So the closing company has to just connect with IPX or whoever it is that's doing it and do a couple of extra documents, but it went very smoothly. It was easy.
Yeah, ours went really smoothly as well. And I'm glad you mentioned the 180 days. You have to close within 180 days. And there are two time frames you have to know. There's a 45-day and 180 days, and they run concurrently. So you don't have 45 days, then 180 days.
Right.
No, it's from start to finish. You have 45 days to identify at least 3 properties, and then everything's got to be closed in 180 days. And I think it has to be closed within the tax year. So, and I think he talks about that in this video. But that's one of
I'm
the
not certain that's right, Rob, because I just did another one just now too, and I found out that I missed by one day identifying the property because I wasn't sure they could qualify for it, and they lost the last 69,000 that they had, but
Oh, yeah.
they were going to be able to close that in January.
Is that
So
right?
yes, I think you can go over a tax year.
Okay. Yeah, and you could probably amend your taxes if you had to catch that if you couldn't do it. But I think this guy talks about that. So without any further ado, let me see if I can get this started. Well, you know what? I have to share my screen. See, I'm learning all this new stuff. So I apologize, guys. My
Oh,
bad.
good. We're all learning.
All right. Now I think we can go. If it's not loud enough, somebody shoot me a text. I'll be watching it or whatever, or just jump in and let me know.
Welcome to our webinar today. This is the introductory class, or basically introductory webinar. We conduct 2 webinars each month. They're complimentary. Typically on the second Wednesday of every month, we do the introductory webinar. And in this one, I don't assume any knowledge whatsoever of 1031 exchanges. Basically, I start from square one and we build from there. And then next week, we'll continue our conversation in the second of 2 webinars that we generally hold every month. We'll talk about some advanced topics, and usually that's held on the third Wednesday of every month. My name is Jim Miller.
Uh-oh. We have a glitch. I'm sorry, guys. Were you all able to hear that okay?
Yes, we could hear it till it stopped.
Yes.
Okay, all right. The video, I don't think his video is very good quality. It is on mine, but I don't think on your all's it shows up that well. But I don't know that he shows a lot of stuff anyway. He does show some stuff. So that's why I provided the link. I'll provide the link to you at the end as we get there, so you can see it better. So I'll go back and we'll pick up where we left off.
Rob,
And I'm the Western Operations.
Yes,
is your first name Robert?
it is Robert.
Okay, is your email address robert.lane?
No, it's rob.lane@exprealty.com. I
Okay,
just recently changed it.
Okay. So the reason why I asked you that is because I have a pamphlet. I just started working with a client wants to do this, and he's done it
Okay.
before. And I have the 7 basic rules that I'm going to send to you in an attachment. And if you want to share that with the team, that'd be great. 7
perfect.
rules
Thanks.
for 10x for 1031 exchange.
Okay, great. Thank you.
Counsel for IPX 1031. What we are, IPX 1031, is in industry lingo, we are a qualified intermediary, and that simply means that we help put the structure together. We create the paperwork. We safeguard the exchange funds so that somebody can legally defer taxes using Section 1031 of the code. Prior to joining IPX back in February of 2003, I practiced real estate law for 14 years back in Western New York, back in Buffalo, in the Buffalo, New York area. And what I've realized currently, I'm outside of located outside of Phoenix, Arizona. What I have noticed is that the real estate transaction really is very similar across the country. Obviously, who's involved differs from region to region. For example, in Western New York, as a real estate attorney, I would be involved in a multi-million-dollar shopping center transaction. I'd also be involved in a $100,000 house closing. So big to little. Out here in the West, I generally do not see attorneys involved in real estate transactions unless the price tag is $3, $5, $10 million or northward. Generally speaking, you have the real estate agents are more active. You've got title officers, escrow officers, and they do the functions of attorneys in Western New York, where I practiced. But also, attorneys are also involved in portions of the Midwest, portions of the Northeast and Southeast. It varies from area to area. Okay, so today I've got 3 objectives. Let's get going. So what I'm going to do is first of all, we're going to compare a 1031 exchange with a taxable sale. Then I'm going to talk about essential elements for a 1031 exchange. And then lastly, we're going to talk about applications. I should mention that I have everybody on mute. And the reason I do that is to cut down the background noise, which tends to be distracting to everybody, including yours truly. And after the webinar, if you have any questions as we go along, please type them in the chat box. And after the webinar is over, which will go about an hour, what I will do is if I have any questions, I will take whoever asked the question off of mute, read the question out loud, and answer the question. Frankly, I don't care how long I'm on the webinar. It's much more important to me that everybody gets their question answered. Okay, so the bottom line, taxes in a sale. So if you sell a piece of property, the general rule, the basic rule is provided by Section 1001 of the Internal Revenue Code. And what that says, if you sell a piece of property, you're going to pay tax on the gain. Now, in a taxable sale, the recognized gain equals the net sales price, which is the gross sales price less the sales cost, commissions, etc., minus the tax basis. Now, as far as I'm concerned, tax basis is the most important number to know in any transaction, and 1031 included, but any transaction, because simply put, the tax basis of a piece of property is the cost of the property for tax purposes. So if you sell a piece of property for more than the tax basis, you have a gain. If you sell it for less than a tax basis, you have a loss. So, and it doesn't matter how, as we're going to talk about how do we calculate tax basis. A lot of times I like to think of it in terms of book value of inventory. So if I had a business, my bookkeeper would assign a book value to the inventory. So if I sell that inventory for more than the book value, I have a gain. If I sell it for less than the book value, I have a loss. So how do we calculate tax basis? We start out with our purchase price. Then we add to it capital improvements. These are improvements that add value, a big thing, like an addition, not an expense item. For example, if I have a single family rental, and let's say I'm in between tenants, and I think to myself, okay, well, if I want to get new tenants in this place, I probably had better put on a new coat of paint, maybe change the carpeting or at least clean the carpeting. No, those are expense items, and I'm going to deduct the cost of those expense items in the year that I pay them. But a capital improvement is a big thing, like an addition. It adds to the tax basis. So then we subtract the accumulated depreciation. We've been taking depreciation on our property and we look at our tax returns and we total up all the depreciation that we've taken over the years, and that gives us the accumulated depreciation. So purchase price plus capital improvements minus accumulated depreciation leaves us with an adjusted tax basis. So let me give you this example. Let's say I originally pay $200,000 for a property. I put in capital improvements of $25,000. I take accumulated depreciation of $10,000. That gives me 200 plus 25 minus 10. It leaves me with an adjusted tax basis of $215,000. So let's assume that I sell the property for $300,000. What is my capital gain? My capital gain is $85,000. The difference between the sales price of $300,000 and $215,000, which is a tax basis, not the difference between $300,000 and $200,000, because capital improvements increase my basis, but depreciation decrease my basis. So in a 1031 exchange, taxes get deferred. But what's the basis of the new property? Now, an accountant is going to tell you something like this. The basis of the replacement property is the purchase price less any gain deferred in the exchange plus any gain recognized in the exchange. That is not the easiest thing to remember. An easier way to remember it is essentially, and this is oversimplifying it, but essentially the basis transfers from the old investment property, the relinquished property, to the replacement property. So let me give you a couple examples. Let's say that we've got this condo in Colorado is going to be the relinquished property in our 1031 exchange. And as our replacement property, we're going to buy this townhouse in Texas. So let's say the fair market value of the condo is $200,000. And to keep things real nice and simple, let's also make the townhouse worth $200,000. It's not necessary, and I'm going to change those numbers in the next slide. So we've done the calculations for the tax basis of the condo, and we've come up with $100,000. So essentially what happens is we do our 1031 exchange and we transfer the basis from the condo to the townhouse. Okay, let's just look over on the left hand side of the screen. Let's assume that I decided instead of doing an exchange, I'm going to do a taxable sale of the condo in Colorado. What am I going to pay taxes on? Well, I'm going to pay taxes on the difference between the sales price of $200,000 and the tax basis of $100,000. I'm going to pay taxes on $100,000. Let's fast forward in time. Let's say we do a taxable sale of the townhouse. Assuming that it still is worth $200,000, what am I going to pay taxes on? The difference between the sales price of $200,000 and the tax basis of $100,000. So this is what we would call a fully tax deferred exchange. Okay, take another example, same properties, condo in Colorado, townhouse in Texas. Let's leave the condo, say it's worth $200,000, but the townhouse is worth more. It is worth $300,000. So the tax basis of the condo we've calculated is $100,000. Remember, our accountant said the basis of the replacement property is the purchase price of the replacement property minus the gain that we deferred, or $200,000. You'll notice if you look at the $200,000, what's it comprised of? Actually, it's comprised of two things. It's comprised of the $100,000 that we carried over from the condo, plus added to that is the $100,000 that we had to come into settlement with when we bought a more expensive property. So you'll notice you have a $100,000 split over on the left. You still have a $100,000 split over on the right. This is also an example of what we would call a fully tax deferred exchange. So what is an exchange? in a nutshell, a 1031 exchange allows an investor to sell their old investment property and use all of the equity, not just the after-tax equity, to purchase their new property. So I like to use the example of making change. So let's say that you and I come up to you and I have a dollar bill, and I say to you, can you help me out? Can you make change for my dollar bill? And you say, oh, sure, I've got 4 quarters. So I give you my dollar bill and you give me 4 quarters. Is there a taxable event for me? Of course not. Before the transaction, I had 100 cents in the form of one rectangular piece of paper. After the transaction, I still have 100 cents, but this time it's in the form of 4 metal spheres. So what changed? The form of my investment. That, in a nutshell, in a very, very, very simple terms, is what a 1031 exchange is all about. I had X number of dollars tied up in this investment property. I sell it, and as long as I reinvest X number of dollars in replacement investment property, I get to defer taxes. It's not tax free, it is tax deferred. Okay, so let's look at it this way. This is showing it in a picture form. So let's assume that this bar on the left represents the equity that we've got on a piece of property. If we sell the piece of property and we decide to pay the taxes, we're actually splitting that equity into 2 pieces, into the tax, which we send away to the taxing authority, and into the net equity, what we reinvest. If we do a 1031 exchange, we get to reinvest all of the equity. Let it go to work for us, generating some more income. A lot of tax advisors have looked at that and said, this is kind of like getting an interest-free loan from the government, because I get to reinvest all of my equity, let it go to work for me, generating more income. And you might think the IRS, because this is happening, they must hate 1031 exchanges. They do not. And the reason they do not is correctly they view 1031 exchanges as a revenue generator, which it is, because 1031 exchanges tend to increase the velocity of real estate transactions. And those real estate transactions generate taxable income in the form of real estate commissions, in the form of legal fees, accounting fees, escrow, title, premiums, fees. Also, when people do an exchange, they usually buy up and they buy a more expensive property, which rehabs, and it helps the property. It also generates some construction jobs and jobs for suppliers, architects, etc., etc. So even though the taxpayer is deferring paying taxes, the fact that they're moving around is generating taxable income. In addition, remember, you get a carryover basis. So the depreciation deduction for the basis is just a little bit less. So there's some foregone depreciation that the exchanger has, which means they're paying a little bit extra taxes because the depreciation deduction is lower. So this generates a lot of money in the economy. Okay, so what happens in a 1031 exchange? If it's sold at the federal level, capital gain rate is between 15 and 20%. Now, ever since the Tax Cuts and Jobs Act went into effect on January 1st of 2018, the capital gains breakpoints has been indexed. And the breakpoints for 2021 are: if you're married filing jointly with an income of $501,601 or $501,601 or more, then you're in a 20% capital gain rate. If you're below that, it's in a 15%. A single taxpayer, the breakpoint is $445,851, and the reason it's a weird number is because these are indexed, and so it's changes every single year. The breakpoints change. So if you're below those thresholds, then you're in a 15% tax bracket. If you're above, you're in a 20% tax bracket. It's graduated, so that's why I say the capital gain rate is between 15 and 20%. Now, the second layer of federal taxes is the gain due to depreciation, and that's going to get taxed at 25%. So any depreciation that you've taken on a piece of property is going to be taxed at 25%. I've had people say to me, well, geez, Jim, if they're going to tax me at 25%, I don't want to take depreciation. And I say, well, it's not quite that simple, because the code's pretty darn clear, because you're going to get recapture, or you're going to pay taxes on what you did take or you could have taken. So if you don't take the depreciation deduction, nobody's going to show up your door and put a gun to your head and take you off to jail and say you're a bad person. But when you sell the property, you're going to pay taxes of 25% on the depreciation deduction that you could have taken. You didn't even take the deduction. The only thing you're going to be able to do is to go back, file an amended return, take the deduction for the last 3 years, and that's it. Everything else is bye-bye. Okay, now the last layer of federal taxes is tax on certain investment income, which includes capital gains, which is imposed by the Affordable Health Care Act. And so that is based on thresholds. That's the amount in excess of the thresholds. The threshold is $250,000 for a married couple filing jointly, or $200,000 for a single filer. The last layer is state taxes. Now, state taxes vary anywhere from 0% if you happen to be in one of the 9 states that do not have state taxes, or up to 13.3% if you happen to be in my neighboring state of California and you make more than $1 million per year. That is a big range. Now, most states I find tend to cluster somewhere in the middle, 4, 5, 6%, somewhere in there. So let's take this example. Our exchanger, who's married filing jointly with an adjusted gross income, has owned a rental house for almost 10 years, and they want to sell the property for $300,000. They originally paid $150,000 for it, put about $30,000 of capital improvements into the property, and took approximately $55,000 in depreciation deductions. They owe $200,000 to the lender. So let's do a calculations. And as the slide says, or the title says, in a taxable sale, all the taxes that I'm going to list can be deferred by doing a 1031 exchange. So first of all, we want to calculate the adjusted basis. They originally paid $150,000 for it. They put in capital improvements of $30,000. They took depreciation deductions of $55,000. So $150 plus $30 minus $55 leaves them with an adjusted basis of $125,000. The second thing we want to do is calculate the capital gain. They're going to pay it. They're going to sell it for $300,000. Let's subtract off the estimated closing costs of, let's say, $20,000. Well, how did I come up with $20,000? It's very simple. I took 7% of $300,000, rounded it to a nice round number, leaving me with a net sales price of $280,000. Then I want to subtract off the adjusted basis that I calculated above, and the capital gain is $155,000. That's what they're going to pay taxes on. So third, we're going to do a rough cut of the federal and state taxes. At the federal level, the capital gain is $155,000. The gain due to depreciation is taxed at 25%. So it's going to be taxed on $55,000. That's going to be a federal hit of $13,750. The gain due to appreciation is $100,000. That gets taxed at this couple's long-term capital gain rate. And how did I come up with 15%? Well, remember, they had an adjusted gross income of $400,000. Now, the breakpoints are based on taxable income. So if you pull out your old Form 1040 and take a look at the form, you're going to find adjusted gross income. And then from that number, you're going to subtract your deductions, standard or itemized deductions, and that's going to give you the taxable income. So taxable income is always lower than adjusted gross income. So they had an adjusted gross income of $400,000. Their taxable income would have been below that. Married couple filing jointly, they're going to be below $501,000. Therefore, they're in a 15% long-term capital gain bracket. Now, the net investment income tax is based on the excess above 250. So they had an AGI of 400,000, which is 150,000 more than 250,000. So that gets taxed. The excess gets taxed at 3.8%. That's going to leave a federal tax of $5,700. At the state level, we're going to assume that we're in a state that does have a state tax. We're going to pick a number in between what I said is what I found to be the normal range, 5%. So 5% of 155,000 is going to give a state tax hit of $7,750. So if they decide that they want to sell, pay the taxes, then reinvest in that equity, they're going to pay taxes. They're going to pull $42,200 out of their equity of $80,000. So let's compare doing an exchange versus a taxable sale. So if we do a sale, the net equity is $80,000. If we do, to pay the taxes at $42,200, we've got equity to reinvest. The balance is $37,800. If we use that figure as 20% down on our replacement property, we're going to be able to buy property worth $189,000. But if we do an exchange, net equity is the same, $80,000. But since taxes are deferred, there's no taxes paid. We've got net equity to reinvest of $80,000. If we use that figure as 20% down, we're going to be able to buy a property worth $400,000. So the net is the exchanger is going to be able to buy about 2.5 times the value of the property without adding cash. Now, it also translates into cash flow. At a 6% return, this is going to generate an additional income of almost $13,000 a year. And remember, I told you about the IRS not disliking 1031 exchanges? This is one of the reasons, because what's that 12,660 get taxed at? Ordinary income rates. It's higher than capital gain rates. Okay, so I'm going to pull you up to 30,000 feet, and we're going to look down on a 1031 exchange using a qualified intermediary. So we start with the exchanger. The exchanger transfers the relinquished property, the old investment property, to a buyer. Now, nice thing about structuring a 1031 exchange using a qualified intermediary is it doesn't matter how the other party to the transaction is going to use or did use the property that's involved in the exchange, or the properties that are involved in the exchange. For example, let's say a single family rental. So the exchanger has been renting this property out. They've been declaring rental income. They've been taking deductions, depreciation deductions, expense deductions. So on their tax return, it is an investment property. They want to sell it. So they contact their real estate agent. The real estate agent finds a buyer for the property. Now, it doesn't matter how the buyer is going to use it. Maybe the buyer is going to use it as their primary residence. Maybe it's going to be their second home. Maybe they're going to rent it out too. Who cares? It doesn't matter. So basically, the buyer comes into escrow or into settlement with all the money that's necessary to buy the property. And the settlement officer, the escrow officer, takes that money in the form of cash, probably loan proceeds, most likely a combination of both, pays off the exchanger's loan, pays the exchanger's real estate commissions, pays all the other transactional costs, the recording fees, transfer taxes if they happen to be applicable. And now the escrow officer is holding what? Net sales proceeds. Now in a normal buy-sell, the net sales proceeds go to the seller. Well, if that would happen, the exchanger's got a taxable event. So what happens is the net sales proceeds go to a company like IPX 1031, a qualified intermediary. In our hands, we call it the exchange account. And we transfer those funds to the seller, and the seller transfers the replacement property to the exchanger. Now, just like the buyer over on the left, it doesn't matter how the seller used the replacement property. Maybe, take a single family rental example again. Maybe it was their primary residence. Maybe it was their second home, or they're renting it out too. Who cares? Doesn't matter. The only thing that matters is the exchanger. They needed to have used the relinquished property for a qualifying purpose, and they need to use the replacement property also. They need to plan on using the replacement property also for a qualifying purpose. So essentially what we have are two simple vanilla real estate transactions. In this oval on the left, our exchanger is selling the relinquished property to anybody for cash. In this one, they're buying the replacement property from almost anybody, again, for cash. Now, the reason I say almost anybody is next week we're going to talk about there are certain restrictions in acquiring replacement property from a related party. So you can sell to anybody for cash, you can buy from almost anybody, again, for cash. So this is this section of the code, and this was revised pursuant to the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act did away with personal property exchanges, so only real estate is eligible for a 1031 exchange. So the code says no gain or loss shall be recognized. Let me stop right there. In tax law, there's actually two types of gain. There's realized gain and there's recognized gain. Realized gain is the potential gain that could be taxed. To me, it's kind of like, big so what. Recognized gets my attention because that's when I have to pay taxes. So we could actually substitute the word taxed for recognized in the statute, and actually it would read a lot clearer. If we said no gain or loss shall be taxed on the exchange of real property held for the productive use in a trade or business or for investment, if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business. In plain language and with a heck of a lot less legalese in it, what that is saying is that any gain that's realized on an exchange of like kind real property will not be taxed until you cash out of your investment. If you partially cash out, you're going to pay taxes on what you don't reinvest. If you fully cash out, you're going to pay taxes. Okay, so it allows deferral as long as you fully reinvest. Okay, there are three basic statutory requirements. You have to have an exchange, you have to have a 1031 qualified use, and you have to have like-kind property. Let me break them down individually. The dictionary definition of an exchange is the act of substituting one thing in return for another. In other words, it's a reciprocal giving and receiving. If I give something to you, for it to be an exchange, you have to give something back to me. Otherwise, it's a transfer. The exchange requirement in the statute can be satisfied one of two ways, either by a direct trade or a swap. So let's say that you and I are sitting in our favorite coffee shop and, obviously properly socially distanced and all that good stuff. So we're sitting in our coffee shop and we're both talking about our respective investment properties. And after a little while, I look at you and I say, you know what? I really like your investment property. In fact, I like your investment property so much, I'd like to own your investment property. And you look at me and you say, you know what, Jim? I like your investment property too. In fact, I'd like to own your investment property. So we come up with this great idea. Hey, let's swap deeds. That satisfies the exchange requirement. How we satisfy the exchange requirement with a qualified intermediary is with a document called the exchange agreement. So let's talk about the structure. The exchanger transfers, and this is the same triangle that I used before. The exchanger transfers relinquished property to the buyer. The dollars go to the QI, the dollars go to the seller, and the replacement property goes to the exchanger. Now, in between the exchanger and the qualified intermediary is a document called the exchange agreement. Now, if you read the terms of an exchange agreement and boil it down to its essential elements, pull out all the legalese, essentially what it is saying is the exchanger agrees to transfer the relinquished property to the qualified intermediary, and the qualified intermediary agrees to transfer it to the buyer through a direct deed. Now, I'm not talking about any special instrument. I just mean a deed that runs direct from the exchanger to the buyer. Now, the exchange agreement also says the qualified intermediary will acquire the replacement property from the seller and transfer it to the exchanger, again through a direct deed. Now, right here in the middle in this oval, there's our exchange. If per the 1031 regulations that came out in 1991 and were updated to include definition of real property in December of 2020, if it is structured properly, the qualified intermediary is deemed to acquire the relinquished property from the exchanger and is deemed to transfer the replacement property to the exchanger. Now, what do I mean by structured properly? Well, there are three very important documents. The first is the exchange agreement. The second is an assignment of contract. So what happens is the exchanger contacts a real estate agent. The real estate agent finds a buyer for the relinquished property, and they enter into a contract to sell it to the buyer on X date for X amount of money. Now, they enter into an exchange agreement with a qualified intermediary, and the qualified intermediary assigns into that contract. And once the qualified intermediary assigns into that contract, they step into the shoes of the exchanger. Per the regulations, we are deemed to have acquired the relinquished property from the exchanger, and we transfer it to the buyer through the contract of sale that we've assigned into. Now, the exchanger goes out and finds the replacement property, enters into a contract to buy it from the seller for X amount on X amount on X date. Now, the qualified intermediary assigns into that contract, and when we assign into that contract, we become a party to that transaction, and we tell the seller, we transfer the money to the seller, the exchange funds that we're holding to the seller, and we tell the seller, don't deed it to us, deed it direct to the exchanger. Now, this satisfies the exchange requirement of the statute. Okay, let's talk about QI, qualified intermediary. So what does qualified mean? According to the IRS, being qualified means that you are net disqualified. So who's disqualified? Well, the exchanger is disqualified if they're holding net sales proceeds. Well, that's actual receipt. Or a related party to the exchanger. If a related party to the exchanger is holding the net sales proceeds, they've got constructive receipt. Also, an agent of the exchanger. Agent is defined as an ex-employee, an attorney, an accountant, investment banker, broker, real estate agent, or broker within the last 2 years. Everyone else is qualified, even this guy. It brings me to my next slide. Some investors have lost money and still had to pay tax. Why? Because they selected qualified intermediaries who either stole the money or lost it in risky or inappropriate investments. Basic due diligence is needed. You don't have to do a full-blown FBI investigation, but you need to do you need to do basic due diligence. Okay, so what do you want to look for in a QI? You want to make sure you want to look for security, you want to look for safety, you want to look for expertise. Now, security, you have a third-party performance guarantee, and in the rectangle on the right, I've got what we carry. And as I said, I've been with IPX since 2003. I've actually been teaching 1031 exchanges since 1997. And even before I joined IPX, security of funds was at the top of my list. And the reason is you have to make sure that the funds are there when you want to buy the replacement property. They need to have a third-party performance guarantee. They should have a significant fidelity bond. We carry a $100 million fidelity bond. They should have 30 mil, or they should have E&O insurance, errors and emissions insurance. We carry a $30 million E&O policy. Where are the dollars invested? Are they safe? We deposit only in large, stable banks in separate bank accounts using the taxpayer's social security number or employer identification number, whichever is relevant to that particular taxpayer. You also want to ask, are they secure? We are a wholly owned subsidiary of FNF, Fidelity National Financial, which owns Fidelity National Title, Chicago Title, Ticor Title, Lawyers Title, Commonwealth Title, Security Union Title, and a number of smaller regional title operations around the country. Okay, you want to check on safety. You want to make sure they have financial strength and sound business practices. Ask them, what are your accounting practices? Do you have third-party audits? Is there somebody outside of your organization that's looking over your shoulder to make sure that you actually have the money on deposit that you say you have? Do they require dual signatures on disbursements? Let me ask you this. Can you have two crooks in the same organization? Of course you can. But what I'm saying is there is nothing that I've listed that in and of itself is the absolute solution. But the fact of the matter is the more layers of security you have, the more actual security you have. You also want to make sure they have written authorization of the exchanger to disperse exchange funds, and they should be complying with the IRS regulations. Why? Because they need to comply with the regs to be within the safe harbors of those regulations. So, essentially, when IRS came out with the regulations in 1991, they essentially said, you know what, if you want to do a 1031 exchange, do it this way. And if you do it this way, if you follow our regulations, we won't challenge you in an audit. So essentially, they gave us a audit-proof way of doing a 1031 exchange. You also want to make sure they have expertise. Do they have trained and certified employees, experienced attorneys? CES stands for Certified Exchange Specialists and staff. Do they have specialized reverse and build-to-suit divisions? Okay. Second requirement is qualified use. Both the relinquished property and the replacement property must be held for a qualified use, and that can be either investment property or property held for productive use in a trade or business. Let me break them down. So let's say that I buy a piece of vacant land out in the middle of nowhere, and I'm not going to do anything to it I am going to hope that the city continues to grow in that direction, or the state or federal government builds that highway that they have planned. Because if either or both of them happen, the value of my property is going to increase. That is considered investment property for 1031 purposes, or property held for productive use in a trade or business. Maybe I've got a single family rental. That's the business of rental. Maybe I have a strip center and I'm operating it. Or I've got a farm or a ranch. That's property held for productive use in a trade or business. It's not property that I hold primarily for sale. That's inventory. What you need to do is you need to focus on the taxpayer's primary intent and actions. and ask the question, did they acquire the property primarily to sell it, or did they primarily plan on operating it or having it for a long-term hold? Now, the reason I put primarily in red and in bold is that the courts interpret that word as of first importance. I've had people say to me, well, geez, Jim, I'm going to buy this property. I'm going to buy this strip center, and I'm going to operate it for, I don't know, 2, 3, maybe 4 years, and then I'm going to sell it. Will I be able to do a 1031 exchange? I said, yeah, no problem. You didn't acquire it primarily to sell it. You acquired it primarily to operate it. Secondarily, you're planning on selling it. So you want to look at what is the primary purpose. It's also not dealer property. Dealer property is property that we hold in the sale of our ordinary course of business. For example, a builder selling homes or developer selling lots. Again, this is ordinary income. It's also not our primary residence. A primary residence is never, ever, ever eligible for a 1031 exchange, nor is it a second home or vacation home that's used for personal purposes. Now, this language comes from a revenue procedure, and it's not real user-friendly, but we're going to talk about this revenue procedure more next week in our continuation. But what it says is if the personal use is more than the greater of 14 days or 10% of the rental period during each of the 2 years before the exchange, it's considered personal use property and not eligible for a 1031 exchange. So let me give you this example. Let's say that I have a vacation rental and I'm actually renting it for 300 days a year. So what is 10% of it? Well, I get rid of a 0, that's 30. So my personal use could be up to 30 days. It's the greater of 14 days or 10% of the actual rental period. Now, properties can be converted from personal use to qualifying use with careful planning and vice versa. Okay, the last requirement is like-kind property. Now, what constitutes like-kind property is very, very broad. The following types of real property are all considered to be like-kind with each other and can be exchanged for each other. Land, commercial buildings, farms and ranches, rental homes, tenancy in common interest, and leases of 30 years or more, including options. That is pretty darn broad. Now, there are exceptions, but you could make the following generalization and you'd be correct far more than you would be incorrect. If you said, for 1031 purposes, all real property is like kind to all real property. Like I said, it's a generalization, but you would be correct far more than you would be incorrect. Now, real property that's held primarily for sale is excluded from gain deferral under 1031 because it's inventory. Okay, let's talk about delayed exchange process. So, same triangle, exchanger transfers the relinquished property to the buyer, $1 goes to the QI, $1 goes to the seller, and the seller transfers the replacement property to the exchanger. We start out with day 0. Day 0 is the day that we transfer the benefits and burdens of ownership of the relinquished property. Then we move ahead 45 calendar days, which is called the identification period. Then we move ahead the balance of 180 days or 135 more days, which is called the completion period. A couple things I want to call your attention to. These are calendar days, so weekends and holidays count. If day 45 falls on Easter Sunday, it will not roll till Monday. Day 45 is day 45. Day 180 is day 180. The other thing is a lot of people like to add 45 days to 180. Don't let them. It's 45 days plus 135 days. The total exchange period is 180 calendar days. So how do we identify? Well, it has to be in writing, has to be signed by the exchanger, has to unambiguously identify the replacement property, and the property identification has to be delivered to a qualified person. Usually that is the qualified intermediary. Now, it has to be delivered mailed, faxed, or otherwise sent within 45 days to a qualified party. As I said, it's usually the qualified intermediary. Can an identification be revoked? Yes. As long as you are within the 45-day identification period, the revocation has to follow steps 1 through 4. Has to be in writing, has to unambiguously identify the replacement, the property being revoked, has to be delivered to whoever the original identification was delivered. Okay, now talk about identification rules. You can identify multiple properties. There's 2 rules, there's 1 exception. The first rule is the 3 property rule. The exchanger can identify up to 3 properties without regard to their fair market value. The second is the 200% rule. Basically, what that says is they can identify any number of properties, but the catch is the total. The aggregate value of all properties identified cannot exceed 200% or 2 times the value of the relinquished property. Now, if you blow both rules, you can still save the exchange with the 95% exception. If you acquire 95% of the value of all properties identified within the 180-day period. So let me give you an example. So let's say I identify 4 properties. Well, that's more than 3 properties. So I'm going to have to rely on the 200% rule. I total up the value of these 4 properties. It's more than 2 times the value of what I sold. That's okay. I can still save the exchange as long as I acquire 95% of the value of all 4 properties, which as a practical matter probably means I have to buy all 4 of them unless one of them is worth less than 5% of the total. The 95% exception is not used frequently, but it is periodically used. Think about it as the all or nothing safety net. Okay, now 3 rules for a fully tax-deferred exchange, aka the napkin test. In order to have a fully tax-deferred exchange, what does that mean? That means that I'm fully deferring taxes. I'm not going to pay any taxes in the year that I do the 1031 exchange. So I want to make sure the replacement property has a purchase price that's greater or equal to the net sales price of the relinquished property. In other words, I want to buy equal or up in value. I want to make sure it has a net equity greater or equal to the equity that I had in the relinquished property. So I spend all of my equity. Last thing I want to do is I want to replace the value of the debt that was on the relinquished property. Now, I want to focus on the word value because sometimes people think you have to replace debt with debt. No, you have to replace the value of the debt. So let's say I sell the relinquished property, a $100,000 loan gets paid off. What do I have to replace? I have to replace the value of the debt. What was that? $100,000. Okay, well, I could do it one of 3 ways. I could put a $100,000 loan on the replacement property. That would replace it with debt. I could come in with $100,000 from outside of the exchange. That would also replace it. Or I could do a combination of both. Maybe put a $50,000 loan on it and come in with $50,000 in cash. Okay, now let me give this example. So the sales price of relinquished property is $300,000. Subtract off the closing costs of $20,000, leaving a net sales price of $280,000, and loan payoff of $200,000, meaning an equity of $80,000. So our exchanger can fully defer capital gain by exchanging into like-kind replacement property that costs at least $280,000, so that they bought equal. With at least $200,000 in debt, they replace the value of the debt with new debt and $80,000 in equity. They would have a fully tax-deferred exchange. So what is boot? Boot is any non-like-kind property that I receive in an exchange. It could be in the form of cash, installment note, debt relief, or personal property. I want to emphasize that a partially tax-deferred exchange is valid. That's where the exchanger receives like-kind property and boot. I can't tell you how often I come across somebody and they say, well, my attorney or accountant says in order to have a valid exchange, it has to be fully tax deferred. That is absolutely wrong. And what that tells me is that attorney or accountant has either never read the statute, because that's pretty darn clear in the statute, and or they don't understand the difference between realized and recognized gain, because a partially tax deferred exchange is valid. Let me give you this example. So let's say that I have $1 million tied up in investment real estate. So I sell it and I buy as my replacement like-kind property worth $900,000, and I receive $100,000 in cash at the end of my exchange. Is $100,000 boot? Yep. Is $100,000 taxable? Yep. Do I have a valid exchange? Absolutely. I just have a partially tax deferred exchange. So what happened? Well, I had $1 million tied up in investment real estate before the exchange. After the exchange, I still have $900,000 tied up. I get to defer with regard to that. But I pulled profits of $100,000 I'm going to pay taxes on what I did not reinvest. So let's shift gears and let's talk about some applications. We can diversify. We can sell one property, buy multiple properties. Sell one, do a 1031 exchange, buy multiple properties. The flip side is also true. We can consolidate. We can sell multiple property and buy one property maybe that's easier to manage. For example, an apartment complex, a commercial strip center, or etc. Okay, now we could also move markets. We could sell in California. Maybe we're tired of the 13.3% state tax, so we could sell in California. We could do a 1031 exchange, buy a replacement property, move to Florida, and buy a replacement property in Florida. We can also do estate planning. Now, 1031 has an awesome use for estate planning. Let's assume dad has 3 children. So dad's a farmer in Iowa. It's a small farm, and he's got 3 children. So if dad passes away and the 3 children inherit the farm in Iowa, what is likely to happen? If you're thinking, fight, I'm going to agree with you, because it's very unlikely that all the children's needs and investment objectives are the same. So let's assume that dad's a farmer in Iowa. He's an aging baby boomer farmer, and his 3 kids have long since moved away from Iowa, and they have families, they have careers, and child 1 lives in Boston, child 2 lives in Manhattan in New York City, and child 3 lives in Los Angeles. So dad passes away, the 3 children inherit the farm. Child 1 says to his brothers, hey guys, there is no way we can sell the farm. It's been in the family for generations. We need to keep the farm in our family name. We'll rent it out. We'll let somebody operate it. Child 2 looks at child 1 and says, are you absolutely nuts? Do you have any idea how much it costs me to live in Manhattan? I am swimming in debt. I need the money to right my financial ship, and so I sail smoothly. Child 3 lives in LA. Really all he wants to do is go surfing, and he just says, I'm not going to fight about it. Whatever you decide, I'll go along with. So instead of dad passing away and the kids inherit the property, dad could sell the farm in Iowa and do a 1031 exchange and buy 3 properties near each child. He could even pay each child to manage the property for him and put each property into a revocable living trust, so that when dad passes away, while dad is alive, it's generating income for him. It's supplementing, it's providing income for his retirement years. A lot of farmers, sometimes they're described as being cash poor and dirt rich, because a lot of times 85, 90, 95% of their net worth is tied up in the dirt, in the farm. And so this provides them with an opportunity to sell the farm, do a 1031 exchange, receive property is going to generate some income, support them in their retirement years, put it in a revocable living trust, and when they pass away, child 1 gets property 1, child 2 gets property 2, child 3 gets property 3. And when that happens, under the current tax laws, there's a step up in basis. So let's assume that the farm was worth $900,000 and it had a basis of $300,000. So dad purchased three $300,000 properties and a basis of $100,000 went to each. So in dad's hands, he had a $300,000 property with a $100,000 basis. Now, when child 1 inherits property 1, he inherits it with the step up in basis, whatever it's worth at that time. So let's say it's appreciated to $500,000. So child 1 could receive the property, immediately sell it, pay 0 capital gains. It's totally forgiven. Or he could continue to own it. Let's say he's been operating it for 7 years for dad. Or he could sell it and he could buy other property that he is going to use, that he's going to do a 1031 exchange with, that's going to generate some income. Child 2 gets to do whatever he wants with property 2, likewise with child 3. Okay, now there's 4 things that you need to remember in a 1031 exchange. Number 1, find a buyer for the investment property. Number 2, get the agreement under contract. Number 3, get the contract into escrow. You do those already. Number 4, contact the QI to set up the exchange. Whatever you do, don't wait until the 11th hour. Okay, that is the end of this webinar, and I want to thank you very much. Are there any questions? And basically, this is our website, and there's a lot of information. There's a lot of resources on there, and I don't see any questions, so I'm going to go ahead and end this webinar. And I want to thank everybody for joining me this afternoon, and I hope to talk to you. Take care, everybody.
So that's it.
I think I'm going to have to listen to that twice. That was really good.
It is good. It's quite in depth. So, and I looked on the website to find next week's, but there was no next week's, as he likes to call it. So there are several other smaller videos that I think will cover stuff that he may not addressed. So, any questions on any of that? All right. Bonetta sent me something here. I got to go find it. So let me get this. I want to share this if I can.
Rob, can you hear me?
I can hear you. Yes.
Yeah, I think Grace. Somebody raised their hand. I think it's Grace. Grace raised their hand.
Yes,
I don't know if
Grace. Grace, go ahead. Grace,
I need your telephone number, please.
my telephone number?
Yes.
Sure. I'll put it in the chat box down here. It's 434-760. Whoops, that's a dash. 5778. There you go.
I'm sorry. I can. Where can I find it?
Oh, okay. Let me just give it to you. It's 434
434
760
760
5778.
5778. Thank you.
Yes, you're welcome. My pleasure.
Rob, I do have one question.
Okay.
He mentioned something at one point where the qualifier, the QI had to go and find a property in the swap. I didn't understand that, why he said that. Because if it's a swap, they're exchanging properties, right? I guess I didn't get that.
Yeah, a swap is kind of one is swapping for the other. So,
Right,
it's not like a purchase, it's just a swap. So,
right.
and I'm not for sure why the QI would be involved in finding a swap.
Exactly. That's what I didn't understand, but
Yeah, and I didn't understand that aspect myself.
okay.
So
Okay.
it's just one of those questions that we could probably reach out to IPX and get that answered.
Yeah, if I run into a situation where I need that, because information overload knowledge is power, but too much knowledge can be confusing.
Oh, absolutely, absolutely, it can.
All
So, but
right.
then
Thanks.
I was trying to share that image, but I don't know how to share it.
I don't know that you can in this kind of situation. Maybe if they reached out to you, or if you could do a blanket email, like a group email out to people
Yeah,
with that as an attachment, then I think that will
We
work.
can,
If you send
I
it.
think we can have Beverly add it to
Yeah,
as the document when
exactly.
she sends out the email. So
Exactly.
Beverly,
Yeah.
can you
yeah,
attach the document, please?
Yeah. I sent him something. I sent Gary something
yeah,
last week, and he that's exactly what he asked Beverly to do, to send that as
yeah.
an
So
attachment. Okay.
I'll take that attachment. I'll forward that to Beverly.
Sounds good.
So I thought the information was very enlightening. I mean, I learned a lot from it. I'm sure there's still more to learn. And it was somebody had told me that you actually have to choose the QI before you get under contract, and that's at the very end of this. I learned that that's not the case. So get your sellers, to get it listed, get it under contract, and once it's under contract, get it into the escrow company, and then have them contact the QI, or you can contact the QI for them. Uh, my suggestion is to send them a list of maybe 3 QIs and have them contact them and choose them. Or I would be comfortable recommending this IPX because it seems like they know what they're doing. And I liked his presentation. I thought it covered everything that I could imagine.
I've dealt with IPX before and they seem to be very good at what they do. So
Yeah, why reinvent the wheel? I had an accountant friend of mine who says he didn't want to be a CPA because all they do is copy, paste, and assemble. It's nothing different. So why reinvent the wheel? We learn from doing, but at the same time, we learn from other people's doings as well.
Rob, do you know what the 4 things that he said, the 4 main things that the realtor needed to do? I didn't. I heard him, but I didn't get a chance to. He put that was at the very end. He said there was 4 main things that the realtor needed to do.
Uh, Other than get it under contract,
Yeah.
or get it listed, get it under contract, get it into escrow, and then contact the QI.
Okay. Get it into
Get
listed.
the
Get
get
it
it under
listed.
right.
Get it under contract.
Yep. And get
I'm
it
writing.
okay, and then get it into
Contract
escrow. So send all your docs to the
and
whoever the buyer choose or the seller chooses for their escrow agent, and then you know get all that information
get it to the QI.
up over to a qualified intermediary, a QI.
All right. Thank you.
I'm sure you're welcome. Any other comments or questions? I'm open for anything. I apologize. This was very long and probably boring, but he obviously knows much more than I do. So I thought it was just better for him to make the presentation than me to stumble through.
Thank you for finding that for us, Rob.
Yeah, it took me several days. Like I said, I was going to be doing a spreadsheet, or I mean a PowerPoint presentation, and do assembling that. That takes a lot of time, and then you got to wonder, well, hopefully I didn't miss anything. So this, I thought, coming from a QI was the best way to do. I mean, they're experts. I'm no expert. It's just much like Gary calling in Lou Brown on trusts. Same concept. It's just that Lou was here and this guy wasn't. So,
Speaking of Lou, who's going to the event up in Pittsburgh in August or the end of this month?
Yeah, I'm not going to be here. I'll be in Wisconsin. I wanted
Gotcha.
to go.
What is that in what is that?
It's Lou Brown's Trust. It's a 3-day event up in Pittsburgh. It's 3 12-hour days. to
Oh
learn
my
music.
God.
I know. But I'm doing it.
Wow.
Lots of caffeine.
Yeah.
Lots of caffeine and lots of potty breaks. Yeah, right? So I wanted to go to the NAEA, but couldn't do that. See? One highly caffeinated, I hope. So anything else, folks? It's now 20 after 8. So if there's no other questions or no other comments, I don't see any here. Grace, I see you had
I think she forgot to put her hand down.
Okay. All right. So if that's it, then you all have a good night, and we'll see you on gig meetings this week, and see you on Monday next week. Is it gigs meeting this week? This week, yes, I think.
Yes.
All right, guys. Take care. God bless. Bye.
Thank you.
All right. Thanks, Rob.
Who's having a gig meeting this week? Who's having a gig meeting this week?
I think the
East Central and West Coast.
Yep.
Oh, do you know who's head of that? I'd like to sit in on one or listen to one or something if I could.
You're in Northern Virginia, aren't you, Bernetta?
I am.
Yeah. Then that's Tom Zachalar's.
Tom.
That's Tom Z.
Okay.
And that's
Do you
going to
know who
be at, I think it's 7 o'clock on Tuesday, I think. Third Tuesday, isn't it?
Yep. Tomorrow.
Yeah, so that's tomorrow.
Oh shoot, I gotta. Do you have a number for
There's-
him or email? Do you all have any of that information? I can reach out to him.
Yeah,
It's in the it's in the
Roster.
it's in the roster.
Yeah, it's in the
Okay.
roster.
And then there's one Wednesday and there's one Thursday is the West Coast and Wednesday is Central.
So you said East Coast is tomorrow,
Yeah.
Uh-huh.
and then
So
West,
tomorrow, Wednesday, and Thursday, you have your pick.
Okay,
Or
Wednesday
you can
is
do
where?
two or all three.
No, I just want to do
A
one. So
Wednesday
if I,
is the Central.
Central. Okay,
Uh-huh.
and then Thursday.
And I think
is
I don't know if Mo's doing that one.
Mo.
I'm not sure if that's who it is. I don't remember. And then I am the West Coast on Thursday.
And I'm sorry, you are.
This is Shirley.
Oh, hey Shirley.
Hey, how you doing?
Good. Shirley, can you text me can you message me your number, please?
I sure can.
I appreciate that.
Okay,
And
I'll send that to you when we're done here.
You can find the gig links in emails from Beverly as well. She always posts the gig links in there
Okay.
for
Mhm.
those upcoming
Okay.
ones. I was looking through to see when the last one was she sent out.
Okay.
Looking through my email, but I don't see it.
All right. Thank you so much. I thought this was very good. I thought it was really informative, and thank you for sharing. That was really, that was really good.
Yeah, you're quite welcome. My pleasure. All right, y'all.
Okay.
See you on
All
the
right,
flip side.
everybody.
Have a good night.
You
Bye.
too. Take care.
Take care.